So Trump just made building wealth easier than it's been in decades, and almost nobody's talking about this. Now, back in July of 2025, he signed the One Big Beautiful Bill into law, and it just opened up a window most people don't know even exists, right? Now, what that means for you is you can now buy a $500,000 Airbnb this year, get over $50,000 back from the IRS just for doing that, and pull in an extra $5,000 to $10,000 a month in cash flow, while also turning every family vacation into a tax write-off. So if you're tired of watching half your paycheck disappear to taxes every year, or you're a veteran or employee who never wants to work for someone else again, that's where I was, then you're going to want to pay attention to this. Now, my name's Ashton Laverick, and over the last 8 years, my family and I have built a portfolio of nearly 90 Airbnbs and over 700 apartment units, equaling over 90 million in real estate. And I did this all as a retired Air Force Special Operations veteran. But spotting policy shifts and tax opportunities like this before everyone else catches on is literally my job now. And by the end of this video, you'll know exactly how to set up your first property the right way, the IRS tax loophole that turns it into a tax-free wealth building machine, and how to turn the whole thing into generational income, all in 5 easy steps. But how is this even possible? How can you buy a property and get most of your money back from the IRS in the same year? Well, a few years ago, my brother and I, we were getting absolutely destroyed on our tax bill. We had over 40 long-term rentals at that point, and we were doing just fine on cash flow. But every April, we'd sit down with our accountant and watch, 6 figures disappear to the IRS. Now, back then, we thought that was just the cost of being successful, of making money in the US. But that was until we bought an Airbnb as a lifestyle play. Now, this property was down by Disney in Florida, but that one property generated around $70,000 in profit in a single year and created a $138,000 tax deduction for me and my family. And that wiped out a massive chunk of what we owed the IRS. Now, that was the moment everything changed for us, because we realized that the wealthy don't get rich from real estate just by waiting 30 years for a property to appreciate, right? No, they use real estate to legally erase their tax bill each year and collect cash flow on top of that for the rest of their lives. And Trump's bill just made the most powerful version of this strategy permanent and accessible to regular people in the US for the first time in modern history. But there is a catch. If you don't invest in the right type of property, or you manage it wrong, the IRS won't let you claim a single dollar of those tax benefits. So your 5 to 6 figure refund disappears, and you're left with a regular home that may even cost you money every month instead of paying you. That's called a liability. And that brings us to the first step. When most people think of real estate investing, they think of long-term rentals or apartment complexes, investing in syndications or REITs, real estate investing funds, or investing passively in other people's projects, right? But the problem is that although these types of investment properties do create massive tax losses, you cannot use those tax credits against your active income. In fact, back in 2020, we were partners on a $54 million apartment complex that had over $9 million in tax credits. But we could not use a single cent of that against my military income, because I was still active duty back then, because the IRS separates active and passive income. But if that property had been a short-term rental, like a vacation home or an Airbnb, then we could have used that $9 million tax deduction to zero out my tax bill for the next decade, right? But vacation rentals like Airbnbs are considered businesses by the IRS, meaning any tax credits created in the purchase and/or operation of this business can now be used to lower your taxable income. And I'll get to the details and how that works in a bit, but the point is, step number 1 is you must buy a short-term rental, because that is the only way this works. But now that you've done that, here's where it gets fun, and where many new real estate investors become Rockefeller-like wealth builders, creating tax-free generational income with every single property they have, right? But it's also the move that most people miss. Now, if you were to place that Airbnb business inside an LLC, inside a holding company located in, say, Wyoming, which was then owned inside a revocable living trust, not only would you create levels of protection that would prevent bad actors from ever coming after your family assets, but you could pass it on to the next generation completely tax-free. And you could do that without going through the lengthy probate process of the court system, right? Which can often take months, even years to resolve before finally passing your wealth and your assets to the next of kin. Because on paper, you own nothing, but you control everything, as Warren Buffett likes to say. And if that isn't reason enough, you can also hire everyone in your family. which is where this really gets fun and really creates generational income, right? In other words, once this legal structure is created and you add your spouse and your kids as members or employees of this business, it transforms this business from a regular business into a legitimate family operation, a family business. But why does this matter? Well, because every time your family travels to that property to check on it, do maintenance, evaluate the market, that trip qualifies as a business trip under the IRS tax rules, right? Which means the flights, the rental car, the meals, all of that becomes a deductible for everyone in your family business. But it gets better. Anytime you take a vacation that includes business-related activities, like finding the next investment property in Hawaii, or a family mastermind retreat in Europe, or maybe a business conference in Fiji, you've just turned a personal expense into a business write-off. And this is exactly why the wealthy families don't take vacations, but they do schedule yearly business trips. Now, I'll be honest with you, getting the LLC set up correctly so it actually qualifies as a real operating business is the part many people get wrong. And if you do it sloppily, not only can a good lawyer collapse the entire structure during a lawsuit, but the IRS can disqualify your family members as part of the business. But when it's done properly, it becomes completely bulletproof. But that's the foundation everything else gets built upon. And now we can move into the part of the strategy that does the actual heavy lifting for you and your family. So the second step is qualifying for the tax loophole I mentioned in the hook. And it's the section of the IRS tax code called the short-term rental tax loophole, or STR tax loophole. And almost nobody outside of high-end CPAs talks about this. Now, why it matters so much is because under normal IRS rules, real estate is what's called a passive investment, which means if you buy a long-term rental, while you will get tax credits from the depreciation of that asset, those paper losses can only be used against other passive income. But it cannot touch your W-2 paycheck, your 1099 income, or your business income, right? So a doctor making $400,000 a year could actually buy a long-term rental, which might give him $100,000 in paper losses, but he'll still owe the IRS the same exact tax bill he would have owed without the property, because this is still a passive loss and cannot be applied to his active income, his doctor's income. The losses don't disappear though, they just sit there waiting for him to make enough passive income so they can then be used there, which most W-2 and 1099 earners never actually do. But the short-term rental tax loophole breaks that rule completely. So if, and only if, your property meets two specific requirements written into the IRS tax code under Section 469, and when it does meet these two requirements, the IRS stops treating it as a passive investment and starts treating it as an active business. And that makes all the difference. Once it's classified as an active business, the paper losses you generate can offset your W-2 income, 1099 income, your business income, and basically any active money you have coming in. And that's how high income earners like doctors, lawyers, pilots, etc. can invest in one Airbnb every year and legally pay close to zero in federal income tax each year. But the two requirements are way simpler than most people make them sound. The first one is the average guest stay at your property has to be 7 days or less, which is basically every Airbnb on the planet. Because if your typical bookings are weekend trips, vacation stays, and family getaways, you already meet this automatically, right? Now, the IRS measures it by dividing your total rental days by the number of bookings. And as long as your average lands at 7 nights or less, you're good to go. Now, the second requirement is what's called material participation. And this is the one most beginners get tripped up on. But trust me, it's way easier than it sounds, especially with modern technology. So the IRS gives you 7 different tests to meet in order to qualify, but you only have to pass one of those. And the easiest test for most short-term rental operators is the 100-hour test. If you spend at least 100 hours per year on your Airbnb operations and more than any single person, including your property manager, you would qualify for this. To put 100 hours in perspective, that's roughly 2 hours a week, and most beginner Airbnb operators hit 100 hours in their first 3 months without even trying, just by doing things like answering guest messages, scheduling cleaners, managing pricing, and handling routine maintenance, right? And I get it. Most people want passive income, so they'll hire a property manager, right? So they can just sit back and collect checks. But in doing so, they automatically disqualify themselves from this tax loophole and miss out on 5 to 6 figure tax deductions, as well as give away 20 to 50% of their profits to a property manager. But check this out. If you were to automate management using a boots on the ground team, some simple smart home technology, and some AI enabled automations, you can meet the 100-hour rule and spend maybe an hour a week managing your investment. In other words, you'll be able to not only make more money because you're not paying a property manager, but you'll be allowed to write off over 30 to 40% of the purchase price in year one, as well as any rehab and furnishing costs. Pretty simple, right? You keep the average stay under 7 days and you put in 100 hours a year, And now your Airbnb is officially classified as an active business in the eyes of the IRS, which is what unlocks the next move and where Trump's bill actually starts doing the work. Now, that's how you set up the LLC and qualify for the short-term rental tax loophole. But real quick, if you want me to walk you through this exact setup live with my team in the room answering your exact questions that could potentially hold you back, that's exactly what we do inside our free 60-minute Airbnb challenge workshop, which I'm running every couple weeks now. And if you want to join us at the next workshop, the link is in the description below where you can reserve your spot and completely free. We'll see you there. Now, step 3 is where Trump's bill actually starts doing the work, right? And it's the move that turns a $500,000 property purchase into a 6-figure tax write-off for you and your family. But to understand why this works, I need to show you something most property owners never actually figure out about their own buildings, about their own investment properties. When you buy an investment property, the IRS would normally allow you to write off the value of that building over the next 27.5 years. This is called depreciation, and it's simply a way to incentivize people to take care of their properties. And they do so by using tax deductions to offset maintenance and repair costs that you're going to incur over the life of ownership, right? So normally if you buy a $500,000 Airbnb, you would normally get to deduct about $13,000 a year in depreciation. That's a long, slow drip of tax benefits that won't really hit you until you're in a nursing home. Now, what most people don't realize is that a property isn't just one giant asset, but it's hundreds of smaller assets stitched together, like the roof, the flooring, the cabinets, the appliances, the HVAC system, the landscaping, the driveway, and every single light fixture in there. And each of those components has its own depreciation timeline that's much shorter than 27.5 years. Now, the problem is that the IRS doesn't separate those components out for you automatically. So by default, everything just gets lumped into this 27.5 year bucket of depreciation, right? Which is why most property owners never see the real tax benefits sitting inside their own investment properties. Now, to pull those individual components out of the 27.5 year schedule and put them on their proper, much shorter schedule of depreciation, you can actually hire a qualified engineering firm to come in and physically analyze your property. And that's called a cost segregation study. And they simply identify every component that legally qualifies for shorter depreciation timelines, things that depreciate over 5, 7, or 15 years, and they reclassify the value of those components accordingly. So for the typical Airbnb, the cost seg study reclassifies roughly 30 to 40% of the property's value into these shorter timelines. So what does that mean for you? Well, on a $500,000 property, you're looking at about $150,000 worth of components that no longer have to wait 27 years to be deducted. The study itself usually costs anywhere from $3,000 to $7,000 depending on the property size, which sounds like a lot until you see what
Step 4
lets you do with the results of it. And it's the move where you take the 100% bonus depreciation on those reclassified components in the same year that you buy the property. Because what most people don't realize is that before Trump signed the one big beautiful bill on July 4th of 2025, bonus depreciation was actually getting killed off year by year. In 2024, you could only deduct 60% of those reclassified components. In 2025, it was set to drop to 40%. And by 2027, it was supposed to hit zero entirely. It would have been completely gone. So the wealthiest operators in the country were watching one of the most powerful tax tools in the entire tax code disappear. And most Americans had no idea it was even happening because nobody else uses this. But when Trump signed the bill, he didn't just save bonus depreciation, he made it 100% and he made it permanent, which means any property acquired after January 19th of 2025 now qualifies for full 100% bonus depreciation forever. Now, what does that actually mean for you? Well, let's take that $500,000 Airbnb as an example. So you put 20% down, you're now $100,000 out of pocket, right, for this investment property. Now, after closing, you bring in a cost segregation firm and they reclassify around $150,000 of the property into those short life buckets we talked about earlier. And because of Trump's new bill, you can now deduct the entire $150,000 against your W-2 income or your business income in the same year you bought the property. If you're in the 35% federal tax bracket, that translates to roughly $57,000 cash back from the IRS. And if you're in a higher combined federal state bracket, you can pull $50,000 to $60,000 back from a single property in year one, which means your $100,000 down payment gets cut nearly in half by the IRS before you even count the cash flow, right? And the cash flow is where everything gets interesting because a well-placed Airbnb in a strong market typically does between $80,000 to $100,000 a year in revenue, which after expenses means you're usually pocketing about $5,000 to $10,000 a month in actual cash flow. Pretty amazing. So when you stack that on top of the tax refund, your $100,000 down payment is essentially fully back in your pocket within the first year of owning the property. But wait, there's more. Meanwhile, the property keeps generating wealth on autopilot, appreciating in value while your guests pay down the debt and the expense of ownership. And every time your family goes on a business-related trip, that trip becomes another tax write-off layered on top of everything else, so long as you structure it properly and the trip is business-related. Now, all that gets you is one wealthy property owner with one tax-free cash flowing asset, which is already a life-changing result in its own. But the reason I told you this strategy stacks into generational wealth is because of step 5. Now, most people who hear about this will buy one Airbnb, take the deduction, take the cash flow, and stop there. And they'll be wealthier than they were before, but they'll have left the real play on the table, the life-changing play, the one that changes your family's future forever. Because the smart move is to take the cash flow from your first property and use it to fund the down payment on your second. Then you run the entire process again with a new LLC, a new cost seg study, and a new 100% bonus depreciation deduction, as well as another $40,000 to $60,000 tax refund, right? Then you do it a third time or a fourth time. And by the time you have 3 to 4 short-term rentals running on this strategy, you're pulling 6 figures of paper losses every single year that can wipe out most, if not all, of your W-2 tax bill, depending on your income. Plus, you're stacking somewhere in the realm of $15,000 to $40,000 a month in cash flow, and the entire thing is owned by an LLC controlled by your family. Now you're playing real life Monopoly here, a game that will eventually have you asking yourself this question: how many investment properties must I own to replace my current income, to retire my spouse, to pay for my kids' college? And how long would it take to hit a certain number? Like, how many rental properties would I need to do XYZ, right? Additionally, when you eventually pass everything down to your kids, the LLC transfers tax efficiently and they inherit a portfolio of cash flowing assets, businesses, without ever paying income tax on the new value that built up over your lifetime. And this is what the wealthy have been doing quietly for decades. Difference now is that Trump's bill made the most powerful piece of this all permanent and accessible at a moment in history where most of the country still has no idea it exists. And we built our entire portfolio doing exactly this. I retired my wife. I moved my family to Costa Rica. I essentially took 21 years of military service and turned it into a life where I only work a couple hours a day, surf, travel with my family, and never worry about money or taxes again. And look, you don't have to be a genius to do this. You just have to follow a simple model of investing. And if you want help following that model with my team, walking you through exactly how to set up the LLC structure, the short-term rental tax loophole, the cost segregation firms we use, and how to find the right property, and of course, how to fund it, that's exactly what we do inside our 60-minute Airbnb challenge, which I'm running again in the next couple days. I'll leave the link in the description below where you can reserve your spot. Other than that, if you found this video valuable, let me know by dropping a like to this video, and make sure to subscribe to not miss any future videos like this, because this is what we talk about: financial freedom, tax-free wealth, generational wealth, right? And what I found is, at any given moment, you're about 1 to 2 vacation rentals away from less taxes and more income every single year. Hope that helps.